This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 504 was produced on October 30th, 2025. I'm Eric Townsend. Santiago Capital founder Brent Johnson returns as this week's feature interview guest. Of course, we'll get an update on Brent's dollar milkshake theory. Then we'll segue from there into the Genius Act stablecoins and why Brent says they're going to be a game changer, even for those who aren't interested in crypto assets more broadly. And I definitely agree with him on that point.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, October 29th, 2025. The S&P 500 index up 285 basis points, trading to 68.90, surged higher, but will the momentum continue in the post-Mag 7 earnings window? We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index up 25 basis points, trading to 99.13, trading to the top of the trade range, begging the question if a new breakout is underway. The December WTI crude oil contract up 338 basis points, trading to 60.48. The December RBOB gasoline up 442 basis points, trading to 189. The December gold contract down 160 basis points, trading to 4,000. The gold correction is now well underway. The December copper contract up 541 basis points, trading to 526. Uranium up 622 basis points, trading to 81.15. And the U.S. 10-year Treasury yield up 9 basis points, trading to 408. The key news to watch next week is the ISM manufacturing and services PMIs, the ADP non-farm employment change, and the government shutdown continues, leaving a lot of economic data in limbo. This week's feature interview guest is Santiago Capital founder Brent Johnson. Eric and Brent discuss the US dollar, stablecoins, gold, and more. Eric's interview with Brent Johnson is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Santiago Capital founder Brent Johnson. Brent prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you haven't registered yet at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button above Brent's picture that says looking for the downloads. Brent, it's great to get you back on the show. You know, I've noticed a trend in the finance podcasting industry. Here's what you do. You're a podcaster, you go on the air, you make shit up in your head about what you think Brent Johnson and Luke Groman each said about the US dollar. You set the context that way. Then you bring one of those guys on and ask them questions that don't make sense because you didn't get the story right. I'm going to resist that temptation. Dollar milkshake theory is your explanation for why you think even though the dollar system might be in big trouble, it's more likely to be upside risk to the dollar relative to other currencies than other people think. You call that the dollar milkshake theory. Give us an update on that because, boy, it's starting to look, I certainly think you already were proven right on that. We saw that unexpected rally up to 116 on the Dixie. Holy cow, but wait a minute. Now it's looking a little bit shaky for the dollar. Let's get an update from the slide deck on the dollar milkshake theory.
Sure. Well, first thing I'll say is thanks for having me back again, Eric. You were one of the first persons to interview me when I first started talking about this. And you were actually, your conference in Vancouver was the first time I ever spoke about it live. So you've been a great supporter of me over the years, and I appreciate you having me back, or having me originally and having me back so many times since then. So as the dollar milkshake theory goes, what it really is it was a framework for me to understand what I thought would happen should we get into a sovereign debt crisis as a result of all this crazy debt that the world has taken out. And I called it the dollar milkshake theory because the dollar underlies the entire global economy. You can't really understand what's going on in the world if you don't understand what's going on with the dollar. And I thought that if we got into a crisis and the system came into some kind of an event that would force it to change, it would be as a result of the dollar going higher. But the idea was never to just sit in dollars and wait for this big implosion. My point was that the dollar was going to rise, and I thought that would have a knock-on effect for several different things. And I'm not going to spend too much time going through the whole theory again, but people can look at the slide decks and the first 10 or 12 pages kind of summarize it. But if you look at page 4, what I really said was I thought 6 things would happen. I thought, because of all the debt in the world, interest rates would finally start to rise after 40 years of going down. I thought that would cause bonds to break. I thought the higher interest rates would pull capital into the dollar and make it rise versus foreign currencies. That pulling of capital into the dollar and into the United States, I thought would also cause U.S. equities to rise. I thought gold would rise as well, both because fiat loses value over time, but also the uncertainty surrounding the monetary system itself. And I said I thought the United States would continue to outperform the rest of the world on kind of an asset appreciation basis. And we did not get the sovereign debt crisis that I thought that we would, but all of the 6 things that I thought would happen as a result of that sovereign debt crisis have kind of played out. The dollar, it's up about 10%, but from COVID, which is when things really kind of got interesting, it's basically flat. But I would point out it's flat despite all the bailouts, despite all the money printing, despite the money printer go burr, despite the expansion of the Fed balance sheet. And so we've just kicked the can down the road. But the framework has helped me understand what's going on in the world and why it's happening the way it has been happening. And so where I think we're at now today, Eric, is we're kind of at the same place we were 5 years ago. There's a lot of people out there who thinks the dollar's days are numbered. There's a lot of people calling for its imminent demise. There's a lot of people who think the American exceptionalism is now over and it's the rest of the world's going to outperform the United States. I just don't think that's the case. I think, if anything, over the last 5 years, the United States dollar has become more entrenched in the world. Despite the great desire to get away from it, I just don't think it's that easy to do. And I think, with the ratcheting up of the trade tensions between the United States and China and the geopolitical tensions between the United States and Europe against Russia, I don't think the next 4 or 5 years are going to be smooth and calm. And I think when things get crazy, I think the dollar will still rise versus foreign currencies. And I think the dollar will become more entrenched than it ever has been. So that's kind of a little bit of an alternative theory than most people have. But, I haven't changed my story in 7 years, and I'm not changing it now.
Okay, that's perfect context because I'm changing my story, Brent. What I would have said until maybe 6 months ago is, look, first of all, you've already been proven right on this as far as I'm concerned. Yeah, we haven't had a full-on sovereign debt crisis, but we really are, in my opinion, having at least an awareness finally of how bad the sovereign debt situation is. And I think it's driving these rises in the dollar and the bonds breaking, the interest rates, everything you said, the gold. I think it is all happening for those reasons. But what I would have said until about 6 months ago is, look, Brent, there's so many people around the world that agree that the dollar is the world's reserve currency because there's no viable alternative, and they're working hard to build that viable alternative. And once they do, I think it's toast for the dollar because I couldn't see any smoking gun that could possibly preserve or salvage that U.S. dollar reserve currency status long term until recently. And I've been looking for somebody to talk about this. You just wrote a 30-page paper about it. So what is the smoking gun that might extend the dollar's hegemony over the global financial system longer than a lot of us thought possible, at least certainly longer than I thought possible?
It's really, really interesting because when this first came out a couple of years ago, I didn't think it was that big a deal. But I've changed my mind on that, having done a bunch of research on it. And that is the rise of U.S. dollar stablecoins. And I think perhaps it's been missed by most for the same reasons I missed it, is that it was, it came up in the world of crypto and these digital assets. And for many people, perhaps they understood the monetary side of it, but they didn't understand the technological side of it. And for many people, when you don't understand something, you just kind of stay away from it and don't really dig into it. And I think there were some shady companies that were involved in the stablecoin market, and that kind of, probably kept me and perhaps some other people from embracing it too much. But what really got me...
Hang on a second, Brent. Let's just do a definition before we go on of for that audience, and it's definitely part of our audience. For the people who are, okay, stablecoins, that's one of those crypto, whatever the heck things. For people who are not interested in crypto, why the hell should you care about a stablecoin? Why should I even care what it is?
Sure. Well, what a stablecoin is essentially a digital token that is then tied to something else that's tangible. So as an example, or something that exists in another form. So rather than a new meme coin, like Doge or something coming out that really gets its value from either some perceived use or speculation, these stable coins derive their value from the underlying assets that it's tied to. So you could have a US dollar stable coin, in which case it's tied in a price manner to the US dollar. You could have a gold stable coin in which, you have this digital asset that is tied to the value of gold. And there's kind of different kinds. Some of them
Let's define that word tied. Brent, what do we mean by tied? Do we mean backed by? Like for every stable coin, there is a US dollar behind it someplace in a bank that hopefully is not in the Bahamas?
That's the idea. And I think for a long time, people were very skeptical of whether there actually was enough backing those stable coins, and if there was enough assets backing it to where if you wanted to return your stable coin for the dollar itself or the piece of gold or whatever it was tied to, that the backing was not there. And I think what really kind of changed this for me was when they passed the Genius Act. Now, I started hearing about the Genius Act a couple of years ago, but it was still kind of in legislative, creation form. It wasn't really an official thing, and it was still kind of on the fringe. But then they literally passed it earlier this year, and Scott Bessent has spoken about stable coins quite a bit. And so it's kind of getting official sanctioning or backing from the U.S. government that it is going to be a thing. And that's what really got me thinking about it in a bigger way. And as I started thinking about it in a bigger way, I think the government is going to mandate in some way or another that these stable coins are backed. And I think transparency is going to need to be more forthcoming than it has been. And I think audits are going to be more stringent than they have been. But the idea, as you suggest, is that, these are backed. And in the past, there have been some stable coins whose backing fell apart, and then the price of those stable coins fell apart. I think that's going to be much more stringent oversight going forward. And that oversight is, again, part of the reason why I think this could be a much bigger deal than people perhaps have realized so far.
Okay, now let's talk about the stablecoin's role here, because what I said years ago when I wrote my book in 2018 is, look, the U.S. government, once they figure out what all this crypto stuff really is, and they realize that it really is a threat to the U.S. dollar's role as global reserve currency, they're going to outlaw it. They're going to do whatever they can to get rid of it. They're going to make it difficult for crypto people. What I never saw coming is that actually there's a way for some crypto assets to kind of be the salvation that saves the dollar from being displaced as the reserve currency. How does that work, and how do stablecoins play into that?
Well, I think you've just hit the nail on the head, and that's kind of the realization I came to. And that is what I would say is that what is emerging here as a result of the Genius Act, and listen, I have to say, and I say this somewhat tongue-in-cheek, but I'm also serious, is that usually when I see the name of a law come out, I laugh because the name is usually the exact opposite of what's going to happen. In this case, I actually think it's appropriate. I think this is a rather ingenious idea by the U.S. government. Perhaps saying Machiavellian is a better way of describing it. But essentially what's emerging is not a decentralized alternative to the global financial order, but rather a deeper centralization, which may be disguised as efficiency and freedom, but is actually quietly reinforces the U.S. dollar as the global reserve currency, and it reinforces the United States government's control over the global monetary system.
So the essence of it is, if you wanted to go digital and you were kind of thinking about ditching the dollar and going with Bitcoin, okay, there's a lot of volatility in that. But if you go not with Bitcoin, but with a stable coin that might be cleared on the Bitcoin blockchain, but it's a stable coin tied to the US dollar, now all of that demand for US dollars is still there, and you don't have the competition from other, Euro stable coins and New Zealand dollar stable coins, because all the stable coins are dollar-based for the most part.
That's correct. 99% of stablecoins in existence are already tied to the US dollar. Now, I have no doubt at all that other countries are going to launch their own stablecoins as a way to kind of compete against the US dollar. But I would say countries around the world that are worried about the US dollar stablecoin should be worried about the US dollar stablecoin. And the reason is, and I'm going to take a step back here, and because I think it's important to understand the argument that we're making. And I think the mistake that a lot of people make is that they think that stable coins are competing with perfection, but they're not. They're not competing with perfection. They're competing with other fiat, right? This is a fiat versus fiat argument. This has nothing to do with Bitcoin. This has nothing to do with gold. It's nothing to do with diamonds or other tangible assets that increase in value over time as fiat loses value. This is a fiat versus fiat battle. And for most countries around the world and most individuals and even kind of small and medium-sized institutions, the US dollar is a much more stable currency than the local currencies in which they transact. And typically in an emerging country or a newly developing country, the government of that jurisdiction has a way to control the monetary flow, the capital controls, what kind of a bank account you can open, what you can hold in the bank account. And so they can protect against an outside monetary influence coming in and disrupting them. But in this case, the technology is allowing citizens, individuals, and, again, small and medium-sized institutions to skip those capital controls or those banking laws or those regulations, because anybody that has a phone, a smartphone, and a connection to the internet can download a wallet and now all of a sudden hold a US dollar balance. Previously, you had to have a bank, and then that bank you had to have a bank account, and then that bank where you had your bank account had to allow you to hold US dollar balances. And then not only that bank had to allow you to withdraw US dollar balances in perhaps physical form. And if that didn't work, then you had to go to some local merchant or some bazaar or some money changer and, pay a big spread in order to get out of your local currency and get into dollars. And this has a way to kind of immediately bypass that entire infrastructure, both regulatory and financial, to allow the people in these jurisdictions to immediately circumvent those controls and hold the US dollar. And what it ultimately gets to is the sovereignty of a country. And this is where, understanding the definition of terms, I think, is pretty important here, because sovereignty basically means ultimate power. And every government wants to have ultimate power over their jurisdiction. But if you are beholden to a country or to another country, or if you are beholden to another currency, which you cannot control, then you are no longer truly sovereign. And as I think these other countries start to become more, quote unquote, dollarized, it starts to eat away at the sovereignty of those local jurisdictions. And it's not an accident. If you look back through history, whenever there's been a currency crisis or a currency has failed, it's not very long after that the government of that jurisdiction typically fails. And again, the reason is a loss of sovereignty. Once you lose control, once you lose power, you're out. And, a new form takes its place. And I really think this is the genius of the Genius Act. It's a way for the U.S. and the U.S. dollar to infiltrate foreign countries, foreign economies, and use the US dollar as a weapon to a greater extent than they already have. And not only that, they don't even have to do it themselves. The market will do 99% of the work for them. And again, it's because the US dollar is a better currency than 99% of the other fiat currencies out there. And so I think a lot of people have focused on the fact that these new stable coins will be a source of demand for the treasury. And that's true. It will be a source of demand. But I think that is a secondary benefit. I think the primary benefit is more of a geopolitical and strategic currency as a weapon that I think will quite honestly change monetary architecture of the entire world.
Let's talk more about that currency as a weapon aspect, because it seems to me that the Genius Act is a mechanism or an invention of the U.S. government. But wait a minute, one of the U.S. government's favorite sanctions is to withhold access to the SWIFT system to prevent people from being able to transact international transactions in U.S. dollars, basically kind of cutting people off from the global, or cutting entire countries off in the context of sanctions from the global monetary system. Well, wait a minute. Don't U.S. dollar stablecoins kind of create a better way to completely bypass and obviate the need for the SWIFT system? And doesn't that undermine the U.S. ability to use that as a sanction tool?
Well, I think it actually enhances it, and I'll tell you why. Is because the SWIFT system is not a U.S. institution. The SWIFT system is actually a European institution. After 9/11, 25 years ago, the U.S. government went to SWIFT, the U.S. Treasury more specifically, went to the SWIFT system, and by using the political pressure of the United States government, was able to, quote unquote, infiltrate SWIFT and get more information from SWIFT. But they still don't have perfect control over it. They have more control than perhaps any other group, but they don't have perfect control. And again, when you go back to sovereignty, every sovereign wants to have total control. They don't like a little bit of control. And they have some visibility, and they have better visibility than anybody else, but they still don't have perfect visibility. These stable coins are basically a new digital architecture that would give them perfect visibility because it's all on the blockchain or a blockchain. I'm not sure which blockchain they would use. Perhaps they could use a couple different ones. But the point is it's not only gives them more visibility, it gives them more control, and it allows them to even better a sanction or remove somebody or cut them off. And so what I think happens over time is they're building this parallel system of, you can call it plumbing or rails, however you want to describe this. And I think this new system will cannibalize the traditional Eurodollar rails and create this new US dollar stablecoin Eurodollar rail, which gives them more visibility, more control, and a greater ability to use it as a weapon should they decide to do so. And I don't think this will happen right away. I don't think they're just going to flip a switch and happen. But the example I've used of how this could possibly go is the LIBOR. You brought up the Eurodollar system. For those who are not familiar, there's an entire system of dollar-based transactions that exists outside the United States. And that system is called the Eurodollar system. And that Eurodollar system is orders of magnitude larger than the US dollar system within the United States. And for many, many years, the interest rate, which was kind of the standard interest rate that was used for the Eurodollar market, was called LIBOR. That was set in London. It's called the London Interbank Offered Rate. And it was basically set by a committee of bankers in London. And again, the United States had a little bit of control over that because it was essentially a dollar-based loaning system, but they didn't have perfect control, and they didn't like that. And over time, they got LIBOR shut down, and they got it transferred over to what's now called SOFR, which is now a U.S.-based rate and one that they have control over. Now, that process took 5, 6, 7 years, but they eventually got it done. And so now LIBOR no longer exists, and now it's SOFR, and the U.S. has more control over it. I could see the same thing happening with these Eurodollar rails and these new, U.S. dollar stablecoin rails. I don't think it's just going to happen by a flip of a switch, but I think it will happen over time. And if you think about it, all the U.S. would have to do would say, hey, this is our new preferred way of doing business. So any vendors they do business with, any payments that they have to receive from other partners or companies or governments, they could say, we want to now use this new system. And it wouldn't take that long for the traditional rails to be cannibalized into the new rails. Imagine if the United States were to be able to get a partner like Saudi Arabia to say, we are still pricing our oil in dollars, but now rather than sending us a Fed wire over the SWIFT system, we would like you to use this new, more efficient, quicker, cheaper system that the U.S. Treasury has blessed. And then all of a sudden, that gives it legitimacy. And for anybody saying, well, no, Saudi Arabia is not going to do that. They want to sell their oil in yuan or rubles, or they're going to join the BRICS. I would just say, keep an open mind. A lot of people didn't think that in 1972, Saudi Arabia was going to price all their oil in dollars, but it happened. And so I think the U.S. has a lot more tricks that it can still play and more power and influence that it can use to make this happen. And especially if the market starts to adopt it on its own, it will make it even easier to do something like this.
Okay, let's go back to the theme of weaponization of currency systems. The goal, or one of the principal benefits of the Genius Act stablecoin, as I understand it, as you're describing it, is basically it gives the U.S. a way to very quickly, almost immediately, bypass all the engineering that would have gone into a so-called Fed coin, a digital dollar, and just say, look, we'll keep U.S. dollars as U.S. dollars. We'll provide the crypto rails, if you will, the digital currency rails on the U.S. dollar by using stable coins, and that allows you to transact stable coins that are backed by dollars, very efficient internationally, don't need the SWIFT system. It's got all these great features, and it does have, I think, a weapon-like aspect to it, which is that it potentially perpetuates the life of the U.S. dollar as the world's global reserve currency. Okay, well, generally, when somebody's got a weapon, whoever their enemy is, observes that carefully and copies it or does something and tries to come up with a better weapon. So if I put myself in the shoes of Sergei Glaziev, the Russian scholar who was the architect of the de-dollarization campaign, imagine he's going and meeting with his counterpart in China. I don't know the name of that individual, but whoever the guy is in China who's, the weaponization of currency guy in the Chinese government. There's probably lots of those guys. And they sit down and they say, okay, what are we going to do? We got to design something. It seems to me we've got the whole world is going to like this digital currency idea. They're going to start using stable coins that are tied to the U.S. dollar for everything. That's going to potentially perpetuate our enemy's currency system. How can we design an even more attractive stable coin than a U.S. dollar-backed stable coin that everybody's going to say, oh, well, since we're already on stable coins, it's easy to switch to a different stable coin, and we're going to go use this other one instead. What would they do? And is there a risk that they come up with something better?
They will no doubt do something, because if they don't do anything, again, they are going to get their economy is going to get hollowed out and dollarized. So the countries that have the ability to fight back will no doubt fight back. And I think the countries that you mentioned, China and Russia, are probably best positioned to fight back. But there's a number of countries out there who won't have that ability and don't have the power or perhaps even the technology or the know-how to do it. And so I think what happens is even countries like Russia and China, will still probably use the dollar stablecoin to a certain extent, but I fully expect there to be a ruble stablecoin, probably a yuan stablecoin. If you look back over the last couple of years, or last several years, last 20 years, how many times have we heard about the e-yuan or the new digital this or the new Libra system? There's been innumerable attempts to come up with a system that is anti-dollar, that has been launched by a competitor, that is going to be the new standard of currency issuance and usage, et cetera, et cetera, et cetera. And it just never, ever comes to anything. And it's not to say that there's not great desire there. But again, you're fighting against the biggest network that has ever existed in the history of the world, and that's the U.S. dollar network. Now, it's not to say that nothing can happen. It's not to say that the U.S. dollar can never be replaced. You always have to keep an open mind to that possibility. But I think my point is that with the network that already exists, the need for dollars that already exists, the desire for dollars that already exists in many of these countries, if now all you're doing is handing them the ability that with a smartphone, they not only hold dollars but transact in them, it's kind of like taking candy from a baby, I would argue. And so, the parents of those babies may not want the U.S. dollar to be in there, and so they will put controls in place and stuff to try to prevent it. But I think it's going to be an uphill battle for them.
Let's go back to the question of the blockchain and how this all works, because what you said earlier is, I was questioning, wait a minute, could this undermine the U.S.'s ability to withhold access to SWIFT as a sanction. And you said, oh, but they'll have even better abilities. Well, hang on. If we're talking about surveillance abilities, definitely the fact that it's all on a blockchain gives visibility to all the transactions. There's an audit trail there that has to be followed. But if we were talking about a cryptocurrency style of blockchain where there is no owner, the U.S. government would not have any ability to prevent a transaction. So are you imagining that this is a different style of blockchain that the U.S. does have control over? And is there a risk that maybe somebody else says, well, wait a minute, you don't want to use this thing for that exact reason, and instead we've got, that's the competitive advantage of something new?
I'm the first to admit that I am not an expert on all this technology to say exactly how this would work. And the other thing I would say is even if I was an expert on the technology, I still wouldn't know exactly how this is all going to get rolled out. But I do know that there is ways that on these different crypto assets or these cryptocurrencies or these different blockchains to basically make it programmable money. And one of the things I've been debating myself with and talking to a bunch of other smart people is this going to be a system where the U.S. Treasury rolls out their own stablecoin or on their own system, or will it be something where they just let everybody, do it? Or will it be something where perhaps they grant a license and they grant 20 licenses to a handful of different multinational banks and financial entities who then issue them. And I don't have a perfect answer to that. I don't know. But what I do know is that part of the reason for doing this is to have more control, right? Governments are not in the business of giving up control. Whatever you think of the Genius Act, I promise you that is not so that they are losing control of the money. It is an attempt to get more control of the money. Now, how exactly they do that, I don't know. But to your point, could somebody else come along and say, this is a way to get out from underneath the state's evil intentions? And I have no doubt that will continue to proliferate, right? That's one reason to own gold. That's one reason to own Bitcoin. It's perhaps a reason to own some of these other, crypto assets that provides an exit from the system. What I think is rather ironic about this, though, is that this new technology and this new innovations that was developed by the private market as a way to exit state control is now, at least from the way I see it, is being co-opted by the state and perhaps implemented on a bigger scale by the state than the free market would prefer to see happening. And so this is where I don't have it worked out perfectly, but I can see where it's headed. And it's again, I go back to the very beginning. It's whether you want to call it genius or Machiavellian, it is rather clever.
Brent, let's come back to what's going on with reserve assets, because central banks around the world watched what happened when the U.S. sanctioned Russia by basically saying, hey, all those treasury bonds that you guys all own, we had the serial numbers and we just canceled them. See you later. Other central banks said, wait a minute, we don't want that to happen to us. They started buying gold. So I guess my question will be in two parts. Seems like there's already a trend going on with central banks. Is there any reason to think that it's going to change, which is they're starting to favor gold over U.S. Treasuries as a central bank reserve asset? But maybe more importantly, is there an angle for some clever, maybe Russia and China, to come in and say, look, we've got a better stable coin that's not just backed by U.S. dollars, but it's backed by gold, and it's audited gold, and they're really, it's basically a gold coin. So you can use the digital currency convenience of instantaneous transactions, but it's all backed by gold, and it's in a vault in Switzerland. It seems to me like if you were a central banker and you wanted to get some of these digital assets and you had a choice between U.S. Dollar Genius Act stablecoins versus some other kind of stablecoin that's on a completely ownerless blockchain that's backed by gold in a neutral country's vault, it's starting to look challenging for that U.S. dollar stablecoin, isn't it?
I don't think so, and I'll tell you why. Because I think we get back to the dollar versus perfection, or the dollar stablecoin versus perfection, rather than dollar versus other fiat. Now, I think there's a place for gold-backed stablecoins, and perhaps some of these other countries will try to do something with gold. But again, you have to remember, most people in the world do not want to hold gold. If they did, they would already hold gold. There's nothing to keep them from already doing it. And the other thing is, if they do want to hold gold as an asset, that's different than holding gold for liquidity, for business reasons, or for, your daily operational needs. And so I don't think this is a gold versus dollar or a gold versus Bitcoin argument. One is a longer term store of value, and one is a day-to-day liquidity needs. And I think we still live in a fiat world, and I think that is going to continue. The other thing I would say is that to the extent that the rest of the world does try to do something with gold, the United States has a lot of gold. So if the dollar gets, or if gold gets repriced higher, and therefore that makes China and Russia, who own gold, in a better position, well, then how does that not also make the United States in a better position because they have more gold than anybody? Now, I know some people will come back and say, the U.S. gold hasn't been audited in 70 years, to which I would say, well, when's the last time you saw China's gold audit? And when's the last time you saw Russia's gold audit? And did you actually get confirmation of it, or did they just tell you they had it? And so the other thing I would say is I can't imagine Russia storing their gold in Switzerland. I can't imagine the PBOC shipping their gold back to the West after spending so much money to buy gold and ship it east. And so and then the last thing I would say is you have to remember the whole way that a gold-backed stablecoin would be given value is the gold that backs it. And the idea is that you could then turn in that stablecoin for the gold. Now, do you think that China's going to give you the gold if you turn in the stablecoin? I don't think they're going to do that. But it doesn't mean that it can't happen. I think it's a rather lower probability event. But I think as it gets back to the US dollar stablecoin argument, you just have to remember that there are absolutely 100% going to be countries that fight against it. And some countries will be more successful than other countries. But there's a lot of countries out there, and there's a lot of people out there, and a lot of small and medium-sized institutions out there who already hold dollar balances or want to hold dollar balances. And the easier that is made available to them, I think the more they will do it. And it is a way, as again, a fiat versus fiat battle. It's a totally different battle than the fiat versus hard assets. The other thing I would say, the other thing is you mentioned central banks looking to hold more gold as reserves than treasuries. And I think that is the case. If we go back to the origins of the milkshake, one of my thoughts was that interest rates were going to rise, bond prices were going to fall, and we'd get into a sovereign debt crisis where sovereign bonds, including U.S. treasuries, are repudiated. And that was one of the reasons why I thought gold would rise, because I said the gold's rise would be, driven primarily by foreign buyers, which I think is what has happened. The other thing I would say, though, is if you look at a lot of these charts, there's a chart I have in here. I can't remember which slide it is off the top of my head, but I think it's slide 13. It's a fairly popular slide that's been going around, and it shows treasuries as a percent of reserves falling and gold as a percent of reserves rising. Now, that's not to say that nobody has sold U.S. treasuries, and it's not to say that nobody has bought gold, but this chart is largely explained by price. Treasury bonds have come down 20 or 30%, and gold has more than doubled. That is partly why, as a percent of reserves, gold has risen and bonds have fallen. That said, I do expect that probably continues in the years ahead. Again, I think we're still going to get into one of these sovereign debt crises where sovereign bonds will be repudiated. And I think in exchange, people will want to own hard assets, whether that's gold, whether it's Bitcoin, whether it's U.S. companies that have property, plant, and equipment. I think we're going to continue to see fiat lose purchasing power. But I don't necessarily think this is going to be necessarily just bad for the dollar and not bad for the rest of the world currencies.
Brent, I want to skip ahead here in the interest of time to, let's see, it's page 21 in your slide deck. You've got the table of contents here, and I guess just the executive summary page for a 30-page paper, which I quite enjoyed reading myself. It is behind your paywall, understandably. How about hooking MacroVoices listeners up with the verbal executive summary of what's in this paper and what it's about?
Sure. The paper is titled Empire by Code, and we titled it that because, again, I was actually surprised myself when I started doing the research on this. I enjoyed doing the research. I enjoyed learning about it, and I enjoyed writing the paper because I think it is a rather big deal. And, I started the paper off with a quote by von Clausewitz, who was a military general. And he said something to the effect that in war, you have to think of all parts of a whole. You can't just think of the individual parts alone. And the point we made, that's the same thing with money. I'm going to tell you a story, and I'm going to tell you about a number of different pieces, but you have to think about it as a whole. And that's what we tried to do with the paper. And so, the different things that we talked about in the paper is what are stablecoins, what is money, how sovereignty plays a role in money, how the euro dollar market developed and how that plays a role in global monetary architecture as well as sovereignty. We then went in to explain the SWIFT system and how that has traditionally been used to kind of regulate not only that, but the ways the U.S. has tried to gain a little bit of control on it. We actually did a special section on the U.S. dollar stablecoin as a weapon. And the point I would make here, I don't know if many people realize it, saying money is going to be used as a weapon, it may sound like a controversial statement, but it should not be. Money has been used as a weapon for centuries, perhaps all of history. And the United States has actually used this has used money as a weapon in several wars, battles, and different military theaters over the years. So this is not some new idea that I've come up with of a way they could do it. This is already doctrine in which they have used it. We then go into the Genius Act and how we think the United States is using the Genius Act to then use all the things we previously wrote about to embed U.S. dollar hegemony to an even greater extent than many people realize. And then we just kind of go through why it all matters and why we think this is important. And we come to our conclusions. And so from a very big perspective, we think that this is a very big deal and perhaps as big a deal as when the United States severed the dollar from gold and left the Bretton Woods system. The point I would make with the paper is we tried to break it up into easily understandable different sections, and the details matter, but the overall structure matters more because what we think is emerging is not just a currency system, but a new form of global control. And the one thing I'll just read you this one paragraph from the executive summary. I won't read the entire thing. But we say, make no mistake, something profound is shifting in the geometry of global money. Quiet code and public ledgers are no longer just symbols of rebellion against the state. They are becoming extensions of it. And the very tools once imagined to escape central authority are now being absorbed by the most powerful monetary authority the world has ever known. Through digital tokens that settle in real time and travel across borders without friction, the United States may be transforming the architecture of control itself. And so, like I said, I don't want to come across as hyperbolic, but we just think this is a very, very big deal. So we've got on our research service, we've got two levels of service. We've got a premium service, which costs $3.99 a year, and we've got a pro level service that costs $23.99 a year. We thought that this report was important enough that we're making it available to both levels of subscribers. If you subscribe to the $3.99 level between now and next Wednesday, which is November 5th, even though this is a pro level report, you will get a copy of this pro level report. That can be found at research.santiagocapital.com. I think this is a pretty big deal. I wouldn't be out talking about it if I didn't. And if nothing else, it's just an incredibly interesting time to be analyzing what's going on in the world. Because if you think about it, this U.S. dollar stablecoin as an idea, it kind of sits at the center of both capital markets, global geopolitics, and the madness of crowds. And if that isn't interesting to you, I don't know why you're listening to MacroVoices.
I couldn't possibly agree with you more, and I definitely want to eat some crow on this one myself. My prediction going back to my book in 2018 is I said, look, at some point the U.S. government is going to figure out how much of a threat the whole crypto digital asset infrastructure that's being built, how much it poses a threat to dollar hegemony. And once they figure that out, they're going to do everything they can to stop it. What I didn't see coming is, no, actually, they're going to figure out how to use it to their advantage. And stablecoins are the mechanism to do that. And I agree with you. It's a game changer. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Brent back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Brent's picture saying looking for the downloads.
Patrick, what's on deck for this week's trade of the week?
Eric, what really stood out to me in Brent's comments was how the dollar milkshake framework still holds. The dollar stays strong, capital keeps flowing into the US, and the other currencies weaken. But as he pointed out, that doesn't mean hard assets lose value. In fact, it's the opposite. Even in a strong dollar world, all fiat is debasing against real assets, and that's where gold comes in. It's the asset that wins when global trust erodes, regardless of what the dollar does. So for this week's trade, I want to focus on positioning long gold within that framework. Now, it's worth noting that we're currently in the middle of a gold correction. Looking back over the last couple of years, these pullbacks have been remarkably consistent. I show this on page 2 of the Trade of the Week slide deck. In December of 2023, we saw a 7.5% correction with the consolidation taking about 78 days. In April 2024, we saw a 6.5% drawdown over 76 days. In October 2024, stretched to roughly 9% over 68 days. And this past April, we had 11% correction where the consolidation lasted 120 days. The current pullback is already over 11% deep, and we're only 13 days into it. Now, the magnitude of each correction tends to correlate directly with the velocity of the prior advance. And since the last bullish impulse in gold was so strong, a deeper retracement was to be expected. What's notable, though, is that we're now approaching the 50-day moving average, the same level that served as support in all 4 prior corrections. So here's the thesis. If you believe the long-term gold bull market remains intact, then this correction should be viewed as a consolidation, not a reversal. If this pattern holds true, this pullback could play out deep into December, with price action basing within a defined range. In that case, the strategy should be to tactically add to gold exposure on weakness, while structuring positions that create some positive carry during the consolidation period. Now, if we accept the view that this is a mid-cycle correction within a long-term gold bull market, then it makes sense to think tactically about how to take advantage of the consolidation period. The option strategy that immediately comes to mind is selling puts for income at the levels where I actually want to be a buyer of gold. It's essentially getting paid to have limit orders in the market, earning premium today for the willingness to take ownership at attractive levels if we get another leg lower. What makes this even more interesting is that, as I show on page 3 of the slide deck, implied volatility on gold remains elevated. We've pulled back from the extreme highs, but we're still sitting in the top quartile of the past year. That means that puts are paying juicy income compared to what gold has historically offered. So rather than chasing the market higher, I can generate carry by selling premium into this correction, get paid to wait, and potentially step into new long exposure at levels I already like. That's exactly how I want to be positioned during a healthy consolidation. So for this week's trade, I want to illustrate the idea directly in gold futures market. I'm looking at the November 24th, 2025 option expiration, which settles the December gold futures contract. At the time of recording, gold is trading around $39.90. If we assume, as in the past 4 corrections, that the 50-day moving average will act as support, that puts our key reference area around 3,900. So I'd target the zone by selling the 3,900 put, roughly $90 below the current price, which is bidding around $54. That means you're collecting roughly 1.4% of the notional in income in under a month, while giving yourself a comfortable cushion to the downside. If you're assigned, you end up long gold at an effective cost base of $3,846, which is right near the area where every prior correction had found support. So this is a classic example of getting paid to do what you want to do anyway. Own gold on a pullback. You're monetizing the elevated implied volatility while positioning to accumulate exposure at a price level that fits your long-term bull thesis.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
Eric, let's talk equities. What are you thinking here?
Well, Patrick, as I've said before, we're in the early stages of a secular inflation, and that inflation is going to be good for the stock market because secular inflations always are good for the stock market in the beginning. The thing is, what everybody remembers is the horribly bad for the stock market part of the inflation, like the 1970s. Well, at the beginning, it felt good in the late 1960s. It's when the feedback loops start to kick in that we haven't gotten to yet that inflation becomes really bad for the stock market. So just be patient, folks. The awful for the stock market part of this secular inflation will come in due time, but it's not time yet. So I think this market can continue higher in the intermediate term. As far as what happens in the immediate short-term time frame, well, anything's possible. I do think there's plenty of reason to think that inflation will carry us higher. At the same time, we're really pretty darn overbought here on a technical basis, so some kind of correction or pullback would certainly be in order. Bigger picture, though, I think it's higher first and then lower on stocks because of inflation, but not until the inflation is really entrenched, and we're just at the beginning of this major secular trend.
Well, look, the S&P 500 has been making higher highs, higher lows. It's now well off the danger zone of the market. Now, here at the time of recording, we're right in the middle of the Mag 7 earnings. We just had Microsoft, Meta, and Google reporting. Later on here, we're about to get Apple and Amazon. I feel that this is really important to see whether these stocks actually can keep the momentum going because the breadth of the market is awful. We're under 50%, which means that the majority of stocks are actually downtrending, not uptrending, which means that these mega cap stocks like NVIDIA and all these other Mag 7s are carrying all of the weight of the S&P's rise. And that we got to really see whether or not they can keep that going. And so watching whether or not these Mag 7s actually are structurally rising in the post-earnings period, I think will be key in determining the short-term path of the markets. Now, even if we do have a little bit of a correction, there's a pretty big cushion. Almost all of the systematic trading triggers that would cause the negative sell feedback mechanism are actually 200 to 300 S&P points lower. So the market has a lot of breathing room here to take short-term corrections and not trigger something bigger. All right, Eric, let's touch on the dollar.
Well, as I said last week and have said before, the Dixie has firmed up toward the high end of its recent consolidation range, but we haven't seen an upside breakout yet. Lots of pundits are calling for one. We'll see what happens. I'll be watching gold's price action and whether it can get back above 4,000 and stay there. That, for me, is going to be a telltale for what's likely next to come for the dollar index. A sustained breakout above the consolidation range, let's call it above 100 on the Dixie, would potentially lead to significant downside risks in several other markets, including equities.
Well, Eric, the U.S. dollar has been consolidating above the 50-day moving average and edging to the top end of its range. What's really interesting here is just after the Bank of Japan's monetary policy statement, we just had the U.S. dollar break out against the yen. The pound sterling has been breaking down, and the euro has been actually very weak. So we're in a situation asking that question as to whether or not the U.S. dollar is going to counter trend. So there's so much bearishness right now about that dollar. And so will we see some sort of a squeeze and counter trend that would certainly cause some intermarket disruptions? All right, Eric, let's touch on oil.
The geopolitical risk premium spike seems to be over, and we're stabilizing around $60 WTI. I still say, though, anything is possible from here. President Trump wants lower oil prices, but at the same time, there are geopolitical risks that could easily escalate to much higher oil prices. I think there is a potential of lower because the president is pushing for it. At the point of that next geopolitical escalation, obviously it's likely to be up. I still think longer term, the picture is up for oil, but a few dollars down, maybe even as much as $10 down from here before we get into that sustained rally is entirely possible. So I don't think you want to chase the long side of oil here unless you're willing to ride out some volatility. I also hosted an oil up versus down debate for Zero Hedge Wednesday night, the 29th of October. The replay link for that Zero Hedge debate, which I hosted, is linked in your Research Roundup email.
Well, Eric, it's an interesting moment in crude oil in that we found some support along its previous year lows. We've bounced, but we've only bounced back to the 50-day moving average and 50% retracement. We have not seen the primary downtrend yet be reversed, but it's a puzzle to see whether or not the selling subsides, whether we see basing formations. I'm actually quite bullish crude oil going into next year, but we have to really see where this downtrend ends. We have to really see where that transition moment to something bullish can happen, because it certainly isn't here yet. All right, moving on to gold here, Eric. What are your thoughts?
Well, it's make or break time for the 4,000-ish key level that a lot of people have been watching. Slow stochastics show gold oversold already. RSI isn't far behind. So, there's a good argument to be made that it's about time for the swing recovery higher on gold, if that's what's about to happen next. The thing is, we're not sure if that's what's about to happen next. If there is a breakout to the upside in the dollar, maybe we'll go from oversold to extreme oversold and gold will keep selling off. Overall, I think there's been way too much fuss over this pullback. Look, folks, we just saw $1,000 of upside on the price of gold over the course of just a few weeks. A significant retracement should be expected. Even a 61.8% fib retracement would not be the slightest bit out of place and would not invalidate the gold bull market. Now, to be clear, I still think this gold bull market is eventually going to end in a very ugly blow-off top and a very harsh, sharp downside reversal. But I don't think we're seeing it yet. I think this is just a pullback. It's an overdue pullback. And yeah, it's almost $500 down now. Okay, you just had $1,000 of upside in the last few weeks. It's to be expected. Now, remember, folks, it wasn't that long ago when we first hit $3,500, and the ensuing consolidation lasted a few months. So that's entirely possible here. Maybe we won't see $4,400 for several more months, but I think it's coming, and I think higher is coming. Eventually, you'll get that very ugly blow-off top, and a lot of people will get hurt chasing it at the end, but I don't think we're there yet.
Well, Eric, like I was talking about earlier in the trade of the week, I want to highlight that a lot of the prior corrections found support near that 50-day moving average, which is hovering just below the 3,900 level. Now, while there is always the potential for a deeper correction, overall, it is a primary bull market. And whether or not that swings a couple $100 more or less, the big question, of course, is where will the key buying opportunities be and where are the accumulation points in this? Overall, prior corrections have lasted 2 to 4 months. So it's very likely here that we may spend a good chunk of the fourth quarter just grinding it out after such a good bull impulse. It should result in a bullish breakout again in the new year, but it really is going to probably be a grind for the next little bit. All right, let's touch on uranium here, Eric.
The reason for the big upside surge on uranium miners and all other things nuclear related was a U.S. government announcement that it will make a huge investment in Westinghouse and possibly subsidize more AP1000 reactor projects in the United States. That is obviously a huge increase in demand that's quite a few years out, so it's not going to affect the immediate spot price of uranium. It does affect the miners and other nuclear stocks. more importantly, in my mind at least, it signals very strong commitment from the U.S. Department of Energy under Secretary Wright's leadership that we're going nuclear, folks, and we're going nuclear in a big way. I think this uranium and nuclear bull market is in its infancy. It's just barely getting started. Now, at the same time, the internet boom was just barely getting started when we had the dot-com bust in 2000. We could easily see, considering how overbought all these uranium stocks are, some negative news flow could really, send us down for a while. But it's temporary. I hope it happens because it'll be a buyable dip.
Well, Eric, on page 10, I have that chart of uranium futures. And what I want to highlight is that while uranium stocks have had a very strong impulse, uranium is just getting things underway. I actually think that owning physical uranium through things like the Sprott Physical Uranium Trust is very interesting here. And there's lots of room for actually the physical uranium to actually make some traction. I still like this chart quite a bit.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
We basically had the FOMC meeting. Powell cooled the market off a little bit with their dovish expectations. And we saw the SOFR futures all react with taking about 10 basis points out of the markets. A lot of the probabilities of a rate cut in December have gone from almost a certainty to now about a 2/3 odds that there will still be a rate cut in December. So things have cooled off, and that caused the 10-year yield and the 30-year yield to both pop a little bit here. The big question is that just a quick little gyration correction, or did something more pivotal change? I think we need a little bit more data. Obviously, there was a reversal on the FOMC, which is an important event moment. And so let's see whether or not this ends up following through or fades that one-day move.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find a transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make this program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.